We mentioned last week that the rally that we've seen in equity markets during the course of the last 6 to 8 weeks was showing signs of some faltering, and indeed this week we have seen continued to see some driftiness. It's not been panicky at all, but what we have seen is just a gentle easing in equity prices, and we're now approaching the meat of the argument. Up until now we've had lots of warm words coming out from central bankers, but as we're videoing this podcast, we're sitting here a few hours before Ben Bernanke stands up at the Jackson Hole conference. In all honesty, expectations for this conference are pretty low by market standards. I don't think that we're expecting any dramatic announcements. Intriguingly, the ECB President, Mr. Draghi, is not present at this conference. He has his workload, I think, is keeping him away from the conference. So, to all intents and purposes, it has the feel of a speech that may prove to be a little bit of a damp squib. But as I say, I don't think market expectations are too high. Where the real action does begin, well, we've got a series of events that take place over the course of the next couple of weeks, including ECB meetings on the 6th. We have the German Constitutional Court that is looking to ratify the ESM programme. That comes up on the 12th. And we've heard this morning, as published in the Daily Telegraph, that the president of the Bundesbank did actually threaten to resign on numerous occasions over the whole issue of bond buying. Apparently Chancellor Merkel encouraged him to stay with the job, but it represents the deep divide that any announcement from the ECB intended to make around the bond buying programme is having within central banks throughout Europe at the moment. So, as I say, intriguing markets ahead of us, and just a little bit of softness in markets going into this particular number. So, first chart is of the FTSE. We can see the rally that has ensued over the last 6 to 8 weeks just tailing off. Now, I want to focus a little bit on what is happening outside of Europe, and let's take a look here at a chart which... This is a chart showing the Shanghai Composite. So obviously, up until now, China has proved to be a solid backdrop to world economic growth, and then that, whilst the West is sorting its issues out, has managed to keep some semblance of normality to world trade and keeping trade moving along. But I find it interesting that the Shanghai Composite Index is continuing to find new lows. This chart we're looking at here is a 1-year chart, but if you were to go back, say, 3 or 4 years, you're looking at an index that is finding the lows last seen in 2009. So maybe there's a message in there about the situation within China, whether that is going to find further fault. Other measures of China demand is coming through in the commodity markets. And this is in what are seen as fairly stable markets. One area of notable weakness has been in the mining sector, and indeed in some of the commodity stocks. This chart here represents the price of iron ore, and we can see here the very significant drop that's been seen from around 140 down to below 100. So it's in a 30% decline in the price of iron ore in a very short space of time, in the space of, as I say, just a course of 6 weeks or so. And I have read comment that at this level 30% of the world's production of iron ore would become unprofitable at this level. So who are the major providers of this? Well, the most notable one here in London is Rio Tinto. They are very heavily weighted towards iron ore as a commodity, and it's been quite a sharp deterioration in its stock price, failing to hold the £28 level that it's seen once or twice this year, and as I say, touched £27. Feels like to me like the bears are getting into some of these commodity big cap mining stocks at the moment, and given that London has more representation in mining certainly than most of the major markets around the world, it could lead to some underperformance relative to other markets in the near term for the FTSE with that particular weighting. So, as I say, intriguing proposition. I think if you're going to see volatility and looking more for trading opportunities, I think the miners are going to be the place to represent that in the near term. It's not just Rio's. Right across the board we have here Anglo-American. You can see their deterioration in their price to year lows. Billiton is holding up better than most, and Billiton has a better oil exposure. and therefore a better balance to its business. So I think it's holding more of a premium rating here. So it is becoming much more sort of commodity based risk there, rather than just a general view across those miners. So you may wish to review your exposure on the back of this. Talking of oil itself has been going against the trend, up around 30% in the course of the last 20% over the course of the last 6 to 8 weeks, and needs monitoring. It's obviously good for oil stocks, but negative potentially for consumer spend in the US. And this week we had rather a poor showing on consumer confidence. The index there was expected to come in at around 66, and that would have been a stable performance month on month, but it actually came in at 60, so 10% below expectations on consumer confidence. So one to watch. And if we just look at the general commodities-based index, then the picture's not too bad. It's holding quite stably, benefiting, as I say, from the higher oil price. But do keep a close eye on, as I say, specifics such as iron ore, which I think is just giving us a little indication of demand for world economic growth. Final chart we're looking at here, just in terms of some of the currencies. I'm looking here at the euro. The euro has continued to find support and moving up towards the 125 to 126 era. It is all indicative, as I mentioned at the start of the presentation, that there are reasonably high hopes for what Mr. Draghi is going to be able to pull out in the next couple of weeks in order to try and sort of stem some of the greater financial risks and burdens on the Eurozone. So as I say, expectations high. So whilst I'm not expecting a lot from Mr. Bernanke this afternoon, Mr. Draghi, expectations are high, and as I say, the euro is reflecting that confidence going forward. There is room for disappointment if he fails to deliver.